Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair on my jacket distract you.
Here's the content. But yeah, we should just get right into the awesome panel day, right?
Let's rock.
Awesome. So first up, we've got everybody welcome to the stage. We've got Tom Lonnie, Bulletproof Wealth Strategist. We've got Chris Picurio, CPA. And we'll have you guys just sit in the order that I'm having you up. So Tom Lonnie, Chris Picurio. We've got Jody Bugter. Okay, Jody Bugter, who is a 1031 exchange specialist, and Roger Romich, who's going to be talking about conservation easements and opportunity zones. So we will jump right into that. You guys can hold the mics as well, too, or pull them up to you. So we wanted to do something a little bit different today. And tax savings is such a wide, broad subject that really it can't just be covered largely by one person. So we wanted to have experts in several different areas who are doing this every day for real estate investors and able to help you guys come up with some ideas that you may not be aware of. So we're just going to start by going down the line. We'll start with Tom, and then we'll hear from Chris, then Jody, then Roger. Maybe just share a little bit of your story. What is it that you do, and why do investors need to be aware of it, and how does this tie in to tax savings? So just maybe five minutes from each of you guys. And so we'll start with Tom.
Okay, thank you guys. Thank you, Seth, for having me come. So my name is Tom Lonnie, and I developed a strategy called Bulletproof Wealth, and what it has to do is saving money inside of life insurance. So it's unbelievable place to save money for tax advantages. You've got the tax code, section 7702 and section 101 outline the advantages of saving money inside of life insurance. And the reason that I put it there for people is because it doesn't tie up their money in a way that they can't get access to it. And the people who want control and access to their money is real estate investors by and large. So that is 99% of who my clientele is people who want control of their money. And those people are people who generally want to stay away from giving it up to somebody else and putting it in the market. And so they want to put it in real estate. And that's what I do. And I'm so excited to get to just go over some of the advantages and some of the ways that I help people do this today. So that's basically what I'm doing.
Yeah, Tom. So Chris?
Well, good morning.
There you go. Should be on now.
Okay, good morning, everyone. My name is Chris Picurio from Integrated CPA Group. Thank you for having me back to the stage, and it's always a pleasure to talk to this group, both here in person and on Facebook Live. Our firm specializes in assisting 4 types of clients within our ecosystem. That's self-employed folks, entrepreneurs with 100 or less employees, real estate investors, and highly taxed households. And we help them do a few different things: save money on their taxes, preserve their wealth, grow their assets, and mitigate financial risks. All that's really fancy for saying we customize solutions for all of our clients. Something that I kind of just thought of, one of our adages is you let your best clients pick your next clients. And that's how I really started getting to seeing a parallel between my most successful and intelligent clients. They may have come from a wide variety of industries, but the majority of them were interested in real estate investing. And similar to what Michael said when he started working with Seth, and why do I want to reinvent the wheel? I learned so much from our clients, and I've taken that onto my own personal investing, and And I just have a passion for helping people out in the real estate industry. So thanks again. I look forward to the discussion.
That's great. Thanks, Chris. Jody?
Let's see if I'm on. Yes, I am.
You're on.
Good morning, everybody. My name is Jody Buchter, and thank you very much for having me today. I work with a company called Asset Preservation. The name is a little misleading in the fact that we are 1031 exchange accommodators. Again, everybody in this room is here. We want to do the best we can with our taxes and real estate, and not everybody understands the full benefit of a 1031 exchange. And today I'm hoping to talk to you a little bit about why people are looking at the 1031 exchange as a great way for helping them defer taxes. So looking forward to speaking with you all today.
Thank you, Jody. And Roger, down on the end.
Get it?
Oh,
There
I'll
you
just
go.
do it this way.
There you go.
Yes, I'm Roger Remick. My company is Retirement Cash Flow Group, and I am an admitted nerd. Years ago, I gave a speech to 4,500 people in an organization that had a lot of debt, a lot of problems. And the next morning, one of my friends said, "My son paid you the ultimate compliment." I said, "What's that?" And he said, "That man seemed like a nice nerd." Years ago, what I did for a living was mostly on the West Coast, but I had the western half of the United States for a company, and I did nothing but talk to CPAs day in, day out, and consult with their clients. My children got to a certain age when I decided I didn't like 300,000 air miles a year anymore, so I stopped doing it. And then last year at age 70, I started again. Why did I start doing it again? Because the 2018 tax law has the two major changes of the last 50 years. Chris, I think, is going to be talking about 199A. I travel all over the country. I've been in Orange County, I've been in New York, I've been in Florida a lot, Virginia, Pennsylvania, etc. Of course, obviously Georgia, because that's where I live. Talking about 199A, but I think you're going to see a different flavor between Chris and I. I don't talk about what it is. I talk about how to solve the problems of 199A, how to save taxes. So that's what keeps me on the road. It's what, unfortunately, doesn't let me get a lot of sleep. I spend a lot of time on airplanes. And years ago, I did what Jody does. I was the national expert for 3 years for H&R Block Financial and H&R Block Tax. And that was a huge on the road, how do I solve problems? So I'm a problem solver, if you want, for taxes. And I didn't ever think I'd start traveling again like I do at age 70. But what I found is there are very few of us who are tax solvers 2018. Thank you for having me.
Very good. Thanks for being here, Roger. We'll just start with Tom. So how we're going to do this morning is I'm going to ask them some questions, and we're going to hear some specific talking points from each of them, and then we're going to open it up to audience questions. Now, if you have a question in the middle of, when Tom is saying something, feel free to just throw your hand up. We do want it to be kind of an interactive space as well, too. Michael's going to be walking around with the microphone as well, too. And if you have questions online, feel free to write those in. Maybe Logan can kind of relay those to us. But we'll start with Tom Lonnie, Bulletproof Wealth. Let's talk about how you can unlock the potential of your wealth by learning what the wealthy are doing to save taxes. You say this, what do you mean by this?
Okay, so a lot of the people I work with are phased out of being able to do a lot of the traditional things that normal people can do because of their income level. And one of the phase outs is like putting money in a Roth IRA. So that phases out. Chris would know, but 2018 it's like 181,000, something like that.
Yeah, it's a little under 200.
Little under 200. So you're not able to do that. And what I'd like to talk with people about as it relates to taxes a lot is whether or not you feel like taxes are going to go up in the future, or they're going to stay the same or go down. And when you really think about it, a lot of people look at the future and go, okay, with the national debt going absolutely crazy and them not really fixing any of the systemic problems related to that, it's likely that in the future it's going to be higher. Most people would agree to that. So I try to find ways to not just push the problem down the road with tax deferral, but try to figure out how to mitigate taxes now. And I know these guys are going to talk about that as well. But a lot of people who have wealth are accumulating it inside of life insurance. It's just not talked about that much. So they're putting money there because it enjoys a tax-favored status where the taxation is basically all of the gains inside of it are never taxed if it's distributed properly in retirement. And you can distribute out all of the basis of the money that you put inside of life insurance in retirement, and that basis will come out with no taxes on it because of the advantages it has, and you will then be able to switch to loans to be able to distribute the rest out. And it's a really amazing place to put it, and a lot of wealthy people are putting their money there. So that is why I try to educate people on, really where can you save it? Where can you store it? And that's the general gist of what it is.
Yeah, and this may be a paradigm shift for you. It absolutely was for me when I first learned about this concept, not keeping all of your money in a bank. Maybe touch on, that, because that's a huge point of what you do is where is it being stored in the first place?
It's exactly right. So banks have some advantages. The main advantage of storing money in a bank is that it's highly liquid. And let's define liquidity, because I read a report the other day that the average person doesn't understand that term. So what liquidity is you have access to money without it losing value. So a house, obviously, if you had to get access to all of the money in your house, in order to get access quickly, you would have to take a loss in value because you can't, they're not liquid. So a bank account has a huge advantage of being liquid, but it has a lot of negatives too. And one of the big negatives of storing money in a bank account is that it doesn't earn any interest hardly at all. It's just very, very little. And then what interest that it does earn is taxable. So any interest earned by storing money in a traditional bank account or savings account, you're going to get it's going to be taxed even on the little amount that you're making in it. So you want to find a place to store money long term that has compound growth and at a much better rate than a bank, like say 4% on average, and still give you access to that money when you need it. So you really don't miss out on opportunities. That's what it is.
Very cool. We'll come back to you, Tom. I want to jump down to Chris. And one of the items that I think a lot of us have questions on, and I personally have a question on, is the 199A deduction with tax reform. How does that affect us? How does it benefit us? Who is this for? How do we interact with that?
Okay, well, great question, and we're going to talk about Section 199A in broad terms, and then we're going to dive into it a little bit later, into the weeds a little bit, but bigger picture, tax reform was the biggest change to our tax law since 1986. As I think I said before, I actually had a hairdo at that point, and the Detroit Tigers were still a good baseball team. So it's a long time ago, and we still had, but I don't want to go down to the Tigers tangent. So we could just root for our former players in the World Series like Verlander. But anyway, back to the tax reform. What tax reform did is it simplified things for individual taxpayers. Those people that we would refer to as W-2 people that have a more basic tax return, and it provided less tax-advantaged opportunities for those folks. Even though there are still some opportunities for them, and Jody is a great resource for people in that situation. What it did do is it definitely complicated things for anyone that has business income. So broadly defined, business income is any type of income that flows through on your personal tax return. That would include if you're a sole proprietor, if you have a DBA, if you're a single member LLC, a multi-member LLC taxed as a partnership, or an S corporation. So basically anyone else except if you were what's called a C corporation. That means you have what it's called potentially qualified business income, or you'll hear the term QBI. Your QBI plays a role in determining if you get what's called if you get a Section 199A deduction. So the tax reform created this new deduction for people that have qualified business income. There are a lot of rules, there are a lot of exceptions, there are a lot of things that play a role as far as, does your business pay W-2 wages? Does it own fixed assets? Is it something called a specialized service business, or are you in an industry that typically like an attorney or a CPA or a doctor? Luckily, real estate brokers and property managers, for some reason, they must have had, they did a really good job lobbying, because they were just excluded from being considered what's called a specialized service business when the IRS came out in August with the really fun additional documentation on clarifying what the tax reform is. So back to the question of 199A. For everyone here, it's an additional deduction you may qualify for, you most likely will qualify for, if you have qualified business income. So if you are in that situation, like a rental property, rental properties qualify for Section 199A. They could be commercial, they could be residential, they could be multifamily. So any type of business income could qualify you for the 199A deduction. In general, the maximum 199A deduction could be 20% of your business income. That's the maximum. That could be a significant amount for you. For people listening on Facebook Live or anyone here that's out of state, you won't want to check with your state to see if there's something called state tax conformity with the 199A deduction. So this is a federal tax deduction, not necessarily a state tax deduction.
Very good. So let's talk a little bit about another one of the big strategies that a lot of us as real estate investors may not know that it is even out there, and can be kind of confusing, but if you know how to use it, can save a ton of money. Cost segregation studies. Can you share what is that?
Sure. Sure. Well,
how can we use it?
In the bigger picture, we are always working with our clients to create a customized solution to either accelerate deductions, accelerate income at times, sometimes we're trying to get your actually recognized income in a year you might not have a lot of income because you're in a lower tax rate. When we were doing Roth conversions, there's different type of strategies. In some cases, especially for real estate investors, you are trying to get your income down. And we're going to talk a little bit about QBI and trying to get to certain numbers of qualified business income and total taxable income to qualify for the 199A deduction. So for some real estate investors, when they buy a property or an investment property, in general, a single family home, you're going to deduct that that expense over a 27.5-year period. When you're buying commercial property, that's it's a 39.5-year asset. So that's a long time to wait to deduct the cost of that property. If you use a strategy called a cost segregation study, what you're doing is you are breaking out the personal property portion of that asset. And you can deduct it at times, a lot of it immediately, or accelerate the deduction of that asset. So for instance, if you bought this beautiful building here, and you could have someone come in, and you could have someone say, okay, well, the lights are personal property. A portion of the sidewalk, maybe the roof could be broken out. Maybe some of the flooring, maybe the light, the sound, the television that's attached to the building, and you can potentially get an accelerated deduction for that. And you could still qualify. Let's say you bought a property 5 years ago. You could still qualify and potentially go back and pick up all of those deductions you should have been taking had you done the cost segregation study many years ago. So this is really important when we run into a client with a spike of income, and we're looking for deductions.
It's good. Let's jump over to Jody. 1031 exchanges. How many people are familiar with 1031s? How many people are not familiar? It's okay if you're not. Okay, great. So maybe we start, first of all, by defining what is it, who is it for, and how can we use them as a tax savings tool?
Thank you for asking that, Seth, because I always ask that question. I don't want to just assume everybody knows what a 1031 exchange is. But as far as a 1031 exchange, what you want to think about is any non-owner occupied property. It can be a rental home. It can be an office property, of course. It can be raw land. But any non-owner occupied property, the Section 1031 code allows you to defer all of the capital gains in that property when you go buy another income investment property. So it's a great code for saving when you're doing real estate and you're going to buy another property. And what a lot of people don't understand and why it's such a great tool is truly what the taxes are on selling an investment property. Most people, when I talk to them, think, oh, I just have a federal cap gains tax on that. Well, the federal cap gains tax is one of 3 taxes possible that you will pay when you sell your property. And the federal cap gains tax can be anywhere from 15% on the low end up to 20% on the high end. But what you have to realize too, as Chris was just talking about depreciation of properties, you can depreciate a commercial property over 39 years, you can depreciate residential 27 and a half years. But another part of the tax on a long-term cap gain of selling a property is recaptured depreciation on your property. So a lot of people don't realize 25% of what you have depreciated over the years will be recaptured for tax purposes. You also have and can fall into, not everyone, the net investment income tax. That's the 3.8 for the Affordable Care Act that we had come on, that if you fall above $200,000 as an individual of unearned income or $250,000 of a couple of unearned income, you start adding in that 3.8% net income tax as well. And finally, we're lucky here in the state of Tennessee, but I do understand that on Facebook Live we have a lot of people from other states. You add in the state cap gains tax. If you're lucky enough to live in the Sunshine State of California, where I lived, the highest tax bracket is 13.3%. So when someone sells an investment property, you're looking as much as to 40-something% of gains. And again, you would have to talk to these smarter gentlemen up here to get you the exact number. But how many people would rather take the full net sales price and go and invest in a property and use all that money as opposed to 40% less? And that's why the cap gains in the 1031 exchange is such a great tool for you to have as real estate professionals. Now, I will say there's a lot of intricacies. It's not as difficult as some people think. I love it. I seem really smart because I know one tax code. These guys here are much smarter than me, but I can certainly answer any questions, but I won't bore you all day on all of the information on it. What I do tell people is, no matter what, if you're thinking of doing a 1031 exchange, the most important thing that you can hear today is to make sure you open up an exchange prior to selling your property. That is probably one of the most important things you'll hear today.
That's good. And I'm just going to piggyback on the end of that because it was going to be my next question, is what are the most common mistakes that you see investors make as it relates to doing 1031s?
Well, it's not kind of learning about it and hearing about it in knowing, because again, there's certain regulations within the 1031 code, and one is you can never have what's called constructive receipt of your funds. So if we go close a property, and although you never took the funds but the money's still sitting in an escrow, the IRS considers that constructive receipt. So no matter what, somebody will call inevitably once in a while and say, oh, I want to do an exchange, and I'll be, great. When is your property closing? Well, we closed it yesterday. I have to be the bearer of bad news that you no longer can do a 1031 exchange. You must set up an exchange prior to closing. Now, I can tell you at Asset Preservation that we have opened up exchanges 1 hour prior to someone closing. I've had somebody call me and say, I've got a client that has decided they want to do an exchange. Can we open up an exchange? And I'm like, great. When are they doing it? When are they closing? Well, we're sitting at the table. So I'll call my home office and I'll say, can we do this? Of course, they always say yes. And I'll say, send the client out to get some coffee. We'll get all the information over to you. It will open up the exchange. So that is probably one of the biggest mistakes. Another mistake, too, is a lot of times I've recently had a client that sold a piece of property, And in order to do a full tax deferral, you can do a partial deferral. But in order to do a full tax deferral where you pay no taxes, you have to go equal or greater of your net sales price, replacing all the equity. And this is what I mean by this. Let's say I sold a piece of property for $1 million. $300,000 of that is equity, $700,000 of it is debt. For me to go and buy and do a full tax deferral, I need to go buy another property at $1 million or greater. If I decided that I wanted to keep $100,000 out to go pay off some debt, and I went and bought a property for $900,000, I can still do my exchange. However, I have what we call $100,000 of taxable boot. Okay? Well, then I had somebody say, well, Jody, I'm going to just take on a little extra debt. I'll replace $200,000, and I'm going to replace $800,000 of debt. And they were going to keep $100,000 of their equity. Unfortunately, although they went $1 million or greater in their net sales price, keeping that $100,000 of equity still caused them a taxable boot. So the key is, in order to do a 100% tax deferred exchange, you have to replace your equity and your debt and make sure all the equity is replaced.
It's great, Jody. And I'm sure there's a lot of questions as well as it relates to that, so we'll come back to some audience questions. But Roger, I want to jump down to you and talk about conservation easements and opportunity zones. I have to admit, when Jody brought this up to me, I wasn't exactly familiar with this strategy, but I went home and did my homework, and it is a fantastic vehicle for tax savings. So maybe share with, you mentioned you're the problem solver when people need to save money on taxes. How do you do that using these strategies?
Yeah, thank you. Yeah, Jody and I frequently work together. As a matter of fact, in a prior life, the way Jody and I met is she was a wholesaler for a group selling 1031 exchanges, and she had the entire East Coast. And I'm happy to say I was her first customer on the East Coast. So we've known each other for a few years, lost each other for a few years, and re-met. 199A and conservation easements, and conversely, opportunity zones we've had conservation easements for 37 years, but conservation easements were not very popular for use until about 5 years ago. What made conservation easements more usable? And the answer is when basically syndicators put conservation easements together. Unfortunately, conservation easements until about 5 years ago were simply Jody and I and maybe Tom got together as individuals and did a conservation easement. Now that's a little bit scary to Chris, I'm sure, because I know he's seen people do that in a sloppy way. What I want to say to you about conservation easements up front is there are a lot of people who poo-poo conservation easements. Let me tell you 3 men who do a lot of conservation easements. President Trump never does a project but when he puts a conservation easement on part of the property. Ted Turner. I live in Atlanta, so Ted, of course, used to be from Atlanta. Ted's nickname was Mouth of the South. He could be very difficult. But Ted Turner's the biggest landowner, talking about real estate. He's the biggest landowner in Montana. He's the biggest landowner in Nebraska. And I think there are 2 other states, but I'm not quite sure what they are. I would guess Wyoming's one of them as well. But he's a huge landowner, and one of the ways Ted, who of course has substantial net worth, avoids paying taxes is by putting a conservation easement on it. How do they work? In the year 2018, the conservation easements from the top 3 or 4 providers of conservation easements will give you about a 4.5 to 1 write-off. So put 40,000 in. I'm an ex-professor, so one of the things I learned is how to make easy examples on the fly. Put 40,000 in, you get $180,000 charitable contribution deduction. That doesn't mean, as Chris will tell you, you can use all 180,000. So there's a Goldilocks element to it. You want to get enough conservation easement to be able to use it in the current year. And secondly, you don't want to get so much conservation easement that you lose part of your 199A deduction, because that's a permanent tax reduction. So I'll tell you, take my numbers. You put 40,000 in, you get $180,000 charitable deduction. Even in a state like Tennessee with your state tax treatment, you get about a 1/3 tax benefit. So what's 1/3 of 80,000? It's $60,000. You put 40 in. When you file your taxes next, 3 or 4 months later, you get a $60,000 tax savings. Those numbers work. Some people in our industry call conservation easements, for obvious reasons, tax cocaine. What do they mean when they say tax cocaine? They simply mean once you do it, you're addicted. You do it year after year after year. Now, my good friend Jody here is going to have to forgive me, because I'm also going to talk about my second topic, which is opportunity zones. Opportunity zones will eventually be the biggest tax change in my lifetime. And I'm 71 years old. Opportunity zones were created by the administration and the Congress to rebuild the infrastructure in the United States. So opportunity zones allow people to avoid paying current taxes on capital gains. Now, the difference between what Jody's talking about, 1031s, and opportunity zones is she's restricted to real estate capital gains. Opportunity zones apply to any form of capital gains. So you have stock in Apple, you got a $500,000 gain. You can take that $500,000, invest it in, say, a Puerto Rico opportunity zone, and you don't have to pay taxes on it currently. You have to pay taxes on it for the tax year 2026, 7+ years from now. And when you do pay taxes, you only pay taxes on 85% of whatever the original gain. Here's the kicker. If you hold the opportunity zone investment 10 years, you pay I'll say that again, no tax on what I call gain on gain. So if I had a $100,000 capital gain, I invested it in a Puerto Rican opportunity zone. At the end of 10 years, it's worth $300,000. I paid tax on 85. 85% of the original 100, and none of the $200,000 gain during the 10 years. You might wonder, well, but how many opportunity zones are they, and are they good areas? I'll give you an example, since it's close nearby here, that will blow your mind. The governor of North Carolina identified Asheville, North Carolina, as almost 100% being in an opportunity zone. So you pick up a bed and breakfast in Asheville, North Carolina, and you improve it, you run it for 10 years, at the end of 10 years, it's worth a lot more than it was when you put it in. You pay tax on only 85% of the original investment and none of the gains. And one place I'm sure Jody and I are going to be working together a lot is when I was the 1031 expert for H&R Block Financial, nearly everybody I talked to did a 1031 exchange. The ones who didn't were the ones who said, I want my money now. And as Jody explained to you, 1031, you got to reinvest every penny you got, including paying off mortgages. You didn't really get that. You have to cover everything. So what I think is going to happen, this is the exciting part of it, is people are going to do combination opportunity zone investing and 1031 investing. That allows them to regulate how much cash they get. Because if they want to take cash, we're going to do an opportunity zone. If they don't want to take, and then the portion they don't want to take cash, they'll do a 1031. Now, the beauty about opportunity zones that Jody doesn't have with 1031s is 1031s have all sorts of government rules that say if you do this, you disqualified your 1031 exchange. You're not going to believe this about opportunity zones. You do not have to do an opportunity zone investment immediately. You have 6 months after the event to decide to put the money into an opportunity zone. So, Jody, when you have those people who you have to say, sorry, you got paid yesterday, and even though you haven't used it, I literally had a 6'7", 280-pound man who was 70 years old put his head down on my desk once about 20 years ago and cry like a baby because I told him, he said, I didn't cash the check. And I said, you have the check. That disqualifies your 1031. It doesn't disqualify an opportunity zone. Think of opportunity zones as a great solution for the oops. Oops, I made a real estate sale, and then later on I decided I should have done a 1031. You can't go back and do a 1031. But for 6 months, you can invest in opportunity zones. How big a deal is it? Let me give you some numbers. Congress estimated that there was 6.1 trillion. That's not billion, that's trillion with a T. Dollars that could go into opportunity zones. Because remember, it's all capital gains. It's exercise of options, it's real estate, etc. And so it's hard for us to appreciate. Remember I said people call me the classic nerd. Give you an idea how big a number 6.1 trillion is. It is 6,100 billion. That's how big a number it is. And they've already decided, Congress underestimated, that the number's closer to $10 trillion of potential opportunity zones. Haven't heard much about it thus far. I have to confess, I haven't looked at a map of Tennessee to see what your governor identified as an opportunity zone. A place like Puerto Rico, the map is all green except one tiny little corner at the top that is not. That means all of Puerto Rico is an opportunity zone. So when the talking press says that Puerto Rico is going to take 20 years to redevelop, do they know what they're talking about? No, they're so dead wrong, it's unbelievable. Because there's groups like a Miami law firm that wants to put $200 million into Puerto Rico because it's a way to save the taxes currently. And if they use it well, they won't ever pay tax on the gains. Incredible opportunity. Haven't heard much about it, you will. Thank you.
It's good. Roger, to piggyback on that, just to give a really clear definition of what these are, why they were created, the conservation easement really is to preserve a resource in its natural, in its present state. And for opportunity zones, it's a new incentive for investing in what is deemed as a low-income community. Am I saying that correctly?
Modify both a little bit.
Okay.
On the first, the conservation easements only restrict usage on what is called highest and best use. So I'm going to give you a Georgia example. Some of you may be familiar, probably a lot of you are familiar with, we have an area down in Greene County, excuse me, where there's a Ritz-Carlton. The reason I say that, use that example is sports figures. Nick Saban is there a lot. President George W. was there a lot. It's a favorite place for people to go. Very, very popular area. They play golf there. It's beautiful lakes around, etc. Across the water is a parcel of land. And of course, what was the Ritz-Carlton worried about? They were worried that somebody built another hotel across the water from the Ritz-Carlton. So they coerced almost those landowners to do a conservation easement. The people who did the appraisal said the highest and best use of that land would be to build another hotel. The key thing, Seth, is that the owners commit to never, and not just for themselves, all future owners can't build a hotel there. But could they put a golf course there or something else? They only commit to one usage on a conservation easement. And on opportunity zones, I would say there's a little bit of a misunderstanding on opportunity zones. It's not necessarily low income. It is property that is not well developed. For example, at my Asheville example, would you call Asheville low income? I don't think so. In Atlanta, for those of you anywhere familiar with Atlanta, all that area west of Georgia Tech was identified by Governor Deal as an opportunity zone. Well, the students going to Georgia Tech would not think they were living in an impoverished area. And all that area historically in Atlanta was not low income, it was industrial. So, met the federal definition. Governor Deal called it an opportunity zone, and guess what's going to happen? 3 miles down the road on the other side of 85 is some of the richest area in all of Atlanta. This area west of Georgia Tech is going to become even richer because people investing there are going to get a huge advantage. So, and Pebble Beach, California. Across the road from Pebble Beach was identified as a conservation easement. Jody and I have a friend who lives in Orange County who looked at a California map to see how much of California had been identified as an opportunity zone. He laughingly said, I think my backyard's in an opportunity zone. A lot of California is an opportunity zone.
Very good. Tom, I can see your wheel spinning. This is a great segue.
Yeah.
One of your points is that you, in the Bulletproof Wealth Strategy, love to help people avoid lost opportunity cost.
Right.
Now, I know your wheels are spinning, hearing all this. How can people take and use what you do, what the opportunity that you create, and leverage it into something like this?
So the way that real estate investors in particular have a huge cost that's sort of hidden is not being able to take advantage of a deal when it's presented to them. So if there's something that comes along the line and somebody goes, hey, I have this amazing opportunity, I've got this a tax strategy that you can put money into and this opportunity cost strategy that we just heard about, you can take advantage of that without interrupting the growth on your money, which is just unbelievable that you can do that. So it's not my strategy does not lock up money. It just prevents you from losing out on deals when they become available. That's the main thing that I love talking about is how to avoid, losing out on a deal when it comes your way.
So can you talk a little bit more specifics on some of the tax advantages of the
Absolutely.
bulletproof wealth strategy?
Yeah, totally, Seth. So once you put money inside of this it's basically a line of credit inside of life insurance. And once it gets in there, it has tax advantaged growth on the money, which means that until you hit into capital gains, it would never be taxed. But if it's distributed properly, it never is taxed at all, ever. And that's the way that I do it, is you can take the money out, all the money out that you put in, and then you take collateralized loans on the gains, and that are never repaid, by the way. That's the thing that is really one nuance I forgot to mention. So it's not like you have to repay those loans ever. It is collateralized by the face value of the contract, and that allows you to just be able to satisfy those at the very end of your life. So those loans are then paid out, satisfied to the insurance company, and the balance is paid to your beneficiary.
And one of the big questions surrounding this is that, the IRS gives people using the strategy favorable tax treatment. Can you talk a little bit about FIFO versus LIFO?
Yes,
as it relates to this?
Totally, Seth. So FIFO is first in, first out. LIFO is last in, first out. So just to give you a real simple, basic understanding of that, if you were to buy, for example, some Apple stock, and it had a basis of $100,000, and it blew up on you, and it came to be worth $200,000. That second $100,000 would be all gain, and if you distributed that money or got that money back out from selling the Apple stock, then all of that second $100,000 that you pull out would be taxed first, because it's the last money in is considered the first money out. And that is the opposite of the way it works in life insurance. So you would be able to pull out the original $100,000 that you put in first, and you would then be able to leave in your gains. So that's a very unique taxation. There's really very, very little that works like that, and that is why it's so advantageous in the way it works. Does that make sense?
Makes total sense. Awesome. Chris, let's jump over to you and talk a little bit about that while we're speaking along the lines of finance planning and banking for real estate investors. Do you have anything to add to this discussion and ways that people might use what Tom is speaking on, or any of these ideas?
Right. Well, a couple of things on both the 1031 exchange and conservation easement and opportunity zone strategies. Just one of the things I see that clients come to us with a misconception is that the money that they could receive, the cash, or you could call it boot, that you could receive at a closing is your taxable income. There very rarely is there a correlation between the money you're receiving at closing and your taxable income due to depreciation deductions, potential cost segregation studies that were performed. There's just a variety of factors involved. So knowing what the tools that they have or the strategies that they present to you are out there, and understanding that if you are considering selling a property, talk to someone, talk to your CPA, and figure out what the taxable portion of that sale is. Clients come to us all the time and say, well, I didn't make any money on it, but I bought it for $200,000 20 years ago, and I'm only getting 190. Do I get a deduction? Well, no, you deducted almost all of it over the last 20 years. So you actually have a large gain. Another thing that could occur is that someone has a gain and the tax on that gain exceeds the cash they're even getting out of the deal. So we can run into some pitfalls, and the point is, and Jody touched on this, planning is so important. You have to ask the questions before you engage in a transaction. Because if you come to Jody or myself or someone says, hey, I just closed this property, what do I owe on my taxes? How does this affect me? We can tell you, but we really can't guide you in any direction and run any scenarios for you. Something to consider on as far as the conservation easement strategy. When we talked about the Section 199A, a lot of that is contingent on your taxable income. Your business income does play a role, but your taxable income is very important as well. So the conservation easement is going to play a role between your adjusted gross income or your business income, let's just say for simple simple discussion, and your taxable income. So there's just, again, it really comes down to figuring out if this strategy makes sense for you and making sure you surround yourself with the team of people. This is tax planning, consulting, it's a team sport. And you want to make sure that you have the right people around you. What Tom offers is a great tool that I've seen clients and my business partner and I also partake in it, and as far as having capital available. So those are very important things. And speaking of having capital available, back to the original question, these things were popping in my head while everyone was speaking, is that CPAs, so there's going to be a World War III out there. It's going to be your CPAs and your mortgage underwriters. And we're going to go down to the Harpeth River and we're going to battle it out because we never seem to get along. And what I mean by that is that a lot of our clients, our motivation as tax advisors and preparers is that we're trying to, in general, reduce your tax exposure as much as possible within the rules that we have in front of us. Well, when it comes to obtaining financing, unless you're working with, I know Billy Brown is ill, or the proper people that understand real estate investing, the underwriters, i.e. the people that are going to look at your file and determine if you're credit worthy, they don't like to see that you don't have a lot of adjusted gross income. And there's only a certain amount of things they're going to add back to your income when figuring out if you're credit worthy in their eyes. And those things are depreciation deductions, sometimes mileage if you are self-employed, sometimes not. So that's something to consider when not only when you are acquiring property, but also when you're having your tax return prepared. In general, you could deduct any repair or maintenance under $2,500 under the de minimis safe harbor rules if you own a rental property. So typically, when I have real estate investors, they're extremely excited to take that deduction. Well, from an underwriting perspective, you might want to capitalize more deductions, especially with Section 199A, and you're getting additional deductions for that, and because that'll get added back to your income when you go through underwriting. So. I know that I went off a little bit again, talking about the tools and stuff, but really it's about strategy because once a tax return hits the IRS's transcripts, it's basically the gospel for mortgage underwriters unless you amend it.
Sure. Jody, one question as it relates to 1031s that I was thinking is, if I'm in a partnership and I want to sell and do a 1031, but my partner does not, what do you do with that?
Seth, that's a great question because it happens all the time. Most people own their properties in partnerships and one partner might want to go forward, the other partner doesn't. So it's like, how do I do an exchange? Because a partnership interest does not qualify for a 1031 exchange. Your vesting must be the same as your relinquished property going forward to your next property. And this often happens. The number one thing that I would say, going back and piggybacking on what Chris said, is planning. Try to plan as much as possible. And for those of you that are sitting in this room and watching on this cast, you're doing a great job because you're learning some invaluable information. There are some strategies out there, some questionable. As we know, the IRS is vague in a lot of issues, and I'm sure that the two CPAs sitting by me can tell you that as well. But what some people do is what we call a drop and swap. And that is where they're going to kind of just get rid of the partnership and then own it in tenant in common. If you can do that, the earliest possible is the best way, because there is some kind of iffy line is how's the IRS going to treat that? Because you're changing vesting and then you got a holding issue, right? When you do a 1031 exchange, what they're looking at, what is your intent? Did you hold for investment? How many people out here have heard that you have to hold a property for 1 year in order to do a 1031 exchange? A lot of people tell me that, but that's probably one of the most false information or myths about 1031 exchange. What the rule says is that you must hold for intent of investment. If somebody says, I'm going to flip a house and I want to do an exchange, I'm like, Flipping in an exchange is something that you don't talk about in the same sentence. So going back to the partnership, the earlier on that you can take the partnership, dissolve it, and go into tenant and common ownerships, the better you're going to be. But then in lies what Chris was talking about, we get in trouble with the lenders. We start having kind of going down the Harpeth River with the lenders on that because they don't like that as well. Have I seen people do a drop and swap? a day before or as soon as possible before they do an exchange, they do. There are some court cases that have precedence. For those of you that are watching in California, do not do it. They are coming down on the ones in California on the state level, but on a federal level, again, it's a business decision that you'll make where if it'll work or not, because people are wanting to do an exchange on that.
It's good. Roger, we'll jump down to you, and then we're going to be opening up to some audience questions. So if you have one that you want to ask, be kind of mentally preparing those, because we will be going around with a microphone. Roger, there are some who maybe object to the very existence of conservation easements and these type of investments. Can you address these objections and perhaps correct some misconceptions about what these deductions are?
Sure. First, the code section that created conservation easements is nearly 40 years old. The intent behind that code section is very good. The problem is that neither the federal government or state governments, because conservation easements can originate at both levels, neither one wants to invest money in developing new parklands, for example, or in new areas, maybe around the Tennessee mountains, where you want it to be open so you can get a good vision of the mountains. If they understand the history of conservation easements, they will know that prior to the very latter stage of the Obama administration, there was very little question about conservation easements. There were some people within the IRS and certainly the Obama administration who didn't like the concept of conservation easements because they viewed them as a tool for the rich. And I've never seen this before. At the end of 2016, on December 23rd, what was going to happen in January of 17? President Trump was going to get the oath of office. So the IRS commissioner issued regulations making conservation easements listed transactions. As a matter of fact, Jody, if I may, Jody has a client over in North Carolina. And she's only one of two advisors for that client. The other advisor is a Goldman Sachs person. And he cannot sell conservation easements. So guess what? He got the CPA firm to write, "We won't do your tax return if you do a conservation easement." The problem is there are lots and lots of better CPA firms that understand the law and have higher level clients. But yes, conservation easements are a political issue. They're a listed transaction, but a good CPA, and I think Chris would back me up on this, is not going to be scared to death of a conservation easement. Now, they should be scared to death of a conservation easement that Jody and I and another friend put together, what I will call the fly-by-night conservation easements. As long as you do a conservation easement with one of the top 3 or 4 companies, I think the odds are good. I can tell you the top 3 have never had an IRS audit that even lowered the valuation. Let me say that again. Never had one that lowered the valuation. So is there a lot of people who, quote, are afraid of them because they're listed transactions? By the way, what did Trump do to that IRS commissioner? First, he slapped him with an edict that said if you ever enforce against conservation easements and you start using your budget to enforce against conservation easements, we are going to slap you with embezzlement charges because you're not allowed to use your budget to audit conservation easements. So a lot of huff and puff, but very little success challenging conservation easements. I want to ask Tom a question, if that's okay. Tom, do you ever do captive insurance companies?
No.
No,
Yes. I mean, I don't. No.
you don't. Who said yes? You
I just
started
said,
to-
you said no, and I was just agreeing with you.
Oh,
I
okay.
don't.
Do you know what a captive insurance company is? Captive insurance company is for health insurance purposes. They will let you set aside money in a company for future health insurance premiums, up to 10% of your revenue. So one of the things I wanted to make you understand, because Jody was talking before we got up here about the fact that she's running into a lot of people, and I know Chris probably has this same phenomena, that say, 199A, well, my income's over 315,000 and I'm married, so I can't use 199A. It is the taxable income that determines whether you can use 199A. So I might have somebody with $1 million net income. First, take 100,000 off the top by setting up a captive health insurance group. Then maybe have them do a retirement plan, take some more off. I wish I had, but I didn't. But when Chris was talking, I should have. I have a diagram that I use around the country that shows what we accountants call adjusted gross income, taxable income. And at the bottom of taxable income, I have a pot of gold in the picture that is 199A deduction. To get the pot of gold, you have to be, though, lower than 415, ideally 315. So if somebody's got an $850,000 adjusted gross income, we don't give up. I got to move that adjusted gross income down into the ballpark of 630,000, which is the Goldilocks number. Then I can do a conservation easement, take it from 630 to 315. And if they're at 315, they get a pot of gold, a 199A deduction of 63,000. I have literally taken people from $1 million to 252. Can you imagine what the difference in taxes is? It's about $280,000 difference in taxes between paying, at the federal level, between paying taxes at the higher level and at 252. And by the way, I don't want them below 315 either, because every dollar we take them below 315, and they're going to be zealous conservation easement advisors who are going to take people below 315. And that's just flat wrong, because when you take them below 315, they lose 199A, and 199A is free. So I frequently talk about the three bears when I talk about 199A planning, but that's the way you do it. Yeah, let me repeat the question. The question is 199A is for the upper echelon. No, normally when I'm instructing, I'll start off with examples like you got a business owner making 80,000. Because if you're making 80,000 and it's qualified business income, as long as your taxable income doesn't go below 80, then you can get 20% of 80,000, you get a $16,000 deduction. And that shows up on a line item. A lot of taxpayers are going to be very happy this year, because they're going to get a nice 199A deduction. The problem is, and Chris, you feel welcome to dispute me on this, I do a lot of speaking at the national level, and I'm on a lot of panels. The guess this year, what percentage of CPAs are well-versed on 199A? If I made you guess, you'd be shocked. It's not 30% or 20% or even 10. It's less than 1%. It's horrible. And Jody will agree with me, I think. People just don't understand 199A, and people are going to lose tens, even hundreds of thousands of dollars of taxes. Now, when I say lose, understand 199A is not deferral. It's permanent, tax avoidance. So when you throw it away, you essentially should be sitting at Thanksgiving with a fireplace and starting to throw $100 bills into the fireplace if you're not doing good planning for 199A.
I know one right here.
Well, yeah, and one of the things I think that Roger's touching on is that the 199A deduction gets phased out when your taxable income, if you're married jointly, goes over $350,000. So if you're under the $315,000, the phase outs aren't as what he's talking about are the people in that higher income level that you're essentially losing the Section 199A deduction if your income's too high. So he's looking at strategies to get your remember the 199A is really based on taxable income, not adjusted gross income. So he's trying to get your taxable income if you're in that situation down to $315,000.
Correct.
And how you do that are using different strategies like conservation easements, opportunity credits, so you're deferring income, qualified, there are a lot of different strategies for that.
And I would also say that my answer would be, how do you find somebody? Well, if you talk to a tax professional, they say, I don't know anything about 199A. I'm not saying fire them, but I am saying get another opinion. And most of the time, this is going to be a team effort, I think. It's not going to be one person.
And I will say, yeah, it is a team sport, and in our industry, at least when you look at small practitioners, let's say people that have firms like myself, the demographic is you have a if I had to put a mean on the age of my profession, it would be between 58 and 60. And some of those folks have been practicing. I've had my license for 20 years, so and I got it when I was 10. But no, I wasn't Doogie Howser. But the thing is that I'm going to be in the game for a lot longer. Some of these folks have been practicing for 35, 40 years, and with this tax reform, it's going to drive out a ton of people out of our industry that just don't want to relearn all this stuff. And so it is difficult. I think the first step would be is if you had your taxes prepared last year, that's your starting spot to determine where you're at for this year. So luckily we use really good software, and we ran pro formas of 2018 saying, what does your tax return look like using the same numbers of 17 into 18? Now, you never have the same numbers, but that's just a starting spot and saying, where are you at today? What's your year-to-date figures? Are you going to qualify for 199A as you are right now? And if not, how do I get qualified for it?
Just to clarify, you guys, do you have to have a certain type of business structure to do 199A? Can you use it as a sole prop, or do you have to be an S corp or?
It's anything other than a C corporation, for lack of a better term. Any flow-through entity, which lends me to, I'd like to hear Roger's take on this. It's going to be very interesting what the K1s are going to look like if you're a partner of a partnership, partner of an LLC, or an owner of an S corp, because part of the 199A deduction will be if your company paid W-2 wages, if you have fixed assets, if you're a specialized service business. And I think it's going to put a lot of pressure on the tax preparers of those entities to properly classify those entities.
And I will say that, talking to Chris beforehand, I do things at a national level, so I have to admit I haven't done at this point as much in Tennessee as I have some other states. California is my #1 state for obvious reasons, and I will point out it's getting worse if you got California land. That 13.3 that Jody mentioned, they are trying to raise to 16+% on capital gains in California. But I think there are going to be some people who don't look at things. They're just going to have a blanket answer. Jody says she gets a lot of people who say, I'm over 415,000. I can't use 199A. That's not even close to correct. You're over $1 million, it gets harder, but not if you are a non-service business. So only the service groups, and Chris said correctly a while ago, I will say this, since we're talking about real estate here. As real estate professionals, you have one heck of a lobby, because originally real estate professionals were service people. The only major change when the 199A regs came out was that real estate professionals were taken out of the service category and put into the non-service category. $1 million worth of income could qualify for a $200,000 199A. Think about that, what that means. Now, capital gains are not included, unfortunately. But that means somebody who's got lots and lots of properties and maybe also does some other type activities that qualify could get a $200,000 199A deduction. And that's going to be worth, at the federal level, that's going to be worth about 35%. So that's going to be worth about $70,000 off the bottom line. 199A is a big deal. Now, my two topics, I will tell you, I have one of the simplest of all times in opportunity zones. Opportunity zones, and this is going to be really important for you real estate investors. Opportunity zones use a concept called self-certification. So you don't have to have even your tax professional say, yes, Jody did it right. Jody signs her tax return, and there's going to be a line on there that says, I followed all the rules. Jody bugged her. Now, of course, it depends on whether the service believes her or not. You know, Jody's a little shady. No, I'm kidding. She's a little aggressive. No. 199A, on the other hand, is, and Chris may agree or not, may be the most complicated code section that I've ever dealt with. There were others like alternative minimum tax and passive losses and things like that, but they only applied to a few people. 199A applies to lots of people, and most of them are not going to get the benefit this year because they don't have advisors who really understand 199A, and it is incredibly complex. Helps to be a nerd on this one.
Well, I want to mention one more thing that with what Roger's talking about for real estate investors. When you are doing flips or if you are engaging in activities that you consider are capital gains, which is a whole nother panel to determine where we report your activities. In general, before Section 199A, anything you could put on Schedule D was preferential because you didn't have the self-employment tax. Well, capital gains is excluded from the 199A. So what I see in the real estate business is more people are going to, it might make more sense to take the stance that your activities all go on, let's say you're just a sole proprietor, all go on Schedule C. Where the service in general wanted to put things on Schedule C previously. So it's just going to, like Roger said, this is very complicated, and you really have to break down your situation and run some numbers and figure out what's best.
Yeah, well, let's open it up to audience questions. Just go ahead and raise your hand. Michael is going to be walking around with a microphone. We've got time for a few. We've got Bill over on the far side.
Thank you very much. Jody, I have a question for you. Can you talk just briefly about a reverse 1031 exchange where I'm going to relinquish a property in the future, but I've got something now I want to purchase? Could you speak a little bit about that?
Yes, Bill just asked me, for those that are on Facebook Live, in case you didn't hear, to ask me a little bit about a reverse exchange. Now, we'd sit here for 3 hours on that as well, so I'm going to give you just the 1,000-foot level on a reverse exchange and explain it for those people here. One of the hard things, as Roger said, compared to an opportunity zone, is there's a lot of different kind of rules you have to follow when you do a 1031 exchange, namely something as a timeline, right? How many of you have heard you've got 45 days to identify your properties, 135 days to purchase one of the properties you identified? So in a market that we've had, as I think everybody would agree, it is a booming market. So a lot of times when you sell that property or you find that property, so to go to what Bill says, I found the property I must have. I want this property, but I haven't even listed my property yet. So what am I going to do? How am I going to do a 1031 exchange? And that's where reverse exchange comes into play. You still have timelines with your reverse exchange as well, but essentially what you're going to do through a 1031 exchange is do a reverse exchange where you can purchase that property, but you personally do not go on title of purchasing that property. Okay, so the qualified intermediary sets up and purchases that title for you, goes on title for you, and then you're able to then put your property for sale. So it is something that you can do. I can tell you, you still have your timelines within that you have to follow, and also something to note as well, it gets a little bit more expensive to do that. Typically a traditional deferred exchange through asset preservation costs you around $1,000. Okay, but doing a reverse exchange, because of the accommodator having to go on title for the property and setting up different kind of entities and so forth, it can be a little bit more expensive. They're done all the time. But again, it's something that I urge you to consult with me, because my goal is to, of course, help you save taxes and to do a 1031 exchange successfully, but we also want to make sure it's worth your while when it comes to the money as well. But reverse exchanges, finding that dream property, is done all the time, Bill.
Thank you.
You're welcome.
Got a question from online from Scott. He says, question about 199A. I am a composer of television scores. Would that be considered a service business?
I'm hoping Chris will answer that one first.
He was hoping this.
Or is that a possible gray area under?
It's a gray
performing
area.
arts?
That's why I was hoping Chris would answer first.
Right. So when Roger mentioned the service came out with I think it was 184-page guidance on 199A, and they had several examples. One of them was a celebrity chef, and if they owned a restaurant, that wasn't necessarily specialized service, but if they used their personality to sell knives or something, it was. Let's hopefully this composer's, doesn't make more than $315,000, and no, I'm just kidding. Sometimes you do run into gray areas. I guess not to not give an answer, but we'd have to dive into the situation a little more and see. My gut feeling is that obviously we don't want him to be a specialized service business if he's composing music, although they do specifically discuss athletes and performing artists. So that's a toughie.
I'm going to attempt it, though. I'm going to attempt it in this sense. If you had a performer go to a composer and say, write me a song, I think that's going to be specialized service. I think, on the other hand, if the writer of the song composes the music and then takes it out and looks for a performer, I happen to be a little bit of a country music junkie. So I'll give you an example. Where many, many years ago, an old example, so obviously, when Chris Christopherson wrote Help Me Make It Through the Night, he didn't write that for anybody in specific. He had Skeeter Davis in mind. And of course, it became far and away the biggest hit ever for Sammy Smith. I don't think that kind of thing would be specialized services. I think, on the other hand, if you had somebody who went specifically to a composer and said, I want you and nobody else to write this music for me, then I think it is a specialized service.
Yeah. I would probably tend to agree, not being a tax professional. We've got, and being a songwriter, so I would tend to agree. Got time for a couple more audience questions as well. Definitely want to have a few minutes at the end for you guys to meet our panelists as well. Does anybody have a question? Yep, in the back.
I think Jody mentioned like early on, just touched on it briefly about depreciation recapture. Could you talk a little bit more about that?
Absolutely, and I'm so glad I have two wonderful CPAs sitting beside me, because what I will tell you, and what Chris alluded to earlier, anybody who comes to me and says, Jody, I bought this property, and then now I own this property, and I'm going to exchange into this, can you help me with your basis? I'm going to look like a deer in a headlight, because again, I know enough to be dangerous, and what I will tell you, and I will always tell you, is you need to consult your professional CPA or your accountant to help you out with those numbers. So as far as, and I'll get these gentlemen to help me out, as far as recaptured depreciation, you do have to go back to your basis. So you have to look at the first property. So that's where it does get tricky. If I owned a property, it started out 10 years ago, and I exchanged to another property, then I exchanged to a third property, it's not just the depreciation I've taken on that property. They go all the way back and look at where you've had depreciation when you stop the cycle of a 1031 exchange. And then again, too, as Chris was alluding to earlier, there's personal property that you depreciate and real estate property that you depreciate. When you're doing an exchange, you cannot exchange personal property any longer. That came in recently, right?
This is the first year.
Yeah, this is the first year you can no longer exchange personal property. That if you own a hotel, if you own apartments, anything that is considered personal property and not actual real estate property, you cannot exchange. So a CPA is going to have to break that out for you. I have an exchanger right now doing a hotel. All the beds, everything is personal property. They will pay cap gains unless they can do something else with that, which these gentlemen can help. But yes, it's 25% recaptured. Chris,
Right.
Do you want to add?
Yeah, and that's one thing I want to make sure, and everyone listening and everyone here, when you have your tax returns prepared, obviously, hopefully you get them in a digital format, or else it's a good cure for insomnia. But make sure you receive depreciation schedules for all your fixed assets. I can't tell you how many times the first thing we do when we have a new prospect is, I need your last year's tax return. And if I don't have a depreciation schedule, that's a problem, because I don't know what your accumulated depreciation really is. So just for easy numbers, if you bought a property for $100,000 and you've depreciated, or if you've deducted $50,000 of it over the years, if you go and sell that for $150,000, you have two types of income. You have a $50,000 capital gain, which is taxed at a lower rate, and then you have a $50,000 of depreciation recapture, taxed at 25% in general. So that's where it really does depend on depreciation. And I will warn you of one very important thing. Sometimes we have clients say, well, I just won't take the depreciation. Okay. Guess what? If you have a ticket to see the Titans and the New England Patriots Sunday, you can't come back Monday and expect that Tom Brady's going to come back and play on Monday night. It's over. So my point is the depreciation recapture is not on just depreciation taken, it's the allowable depreciation. So the fact that you just decided not to take it does you absolutely no good.
And since I'm not a practicing CPA anymore, I only do the high-level planning. I'll tell you a deep, dark secret that maybe Chris wishes I didn't. If you get your tax return, your CPAs will frequently I'm sure Chris, will not give you a depreciation schedule. Why? Because if they don't give you a depreciation schedule, then it's hard for you to move to some other CPA, because you don't have the information that the new CPA is requiring. I will also tell you that on terms of what Jody said and Chris said, you need to understand that on the personal property, where you have a capital gain and where you have depreciation recapture. You can't do it on the 1031s going forward. You will be able to do it on opportunity zones. Why? Because opportunity zones, it's hard to believe how simple the text in the tax law is. It says any capital gain. And I would underline the word any. It's depreciation recapture because that's defined as a capital gain item. It's the sale of Apple stock. It's the exercise of options. It's a lot of different things.
It's good. Well, as we're closing out, how can our people that are watching online and people here interact and work with you guys? Maybe just go down the line, contact information. What's the best way for them to connect with you?
Okay, I'll start. Okay, so I have a website. It's stressfreeplanning.com, and all you have to do is put your name and email address in, and it'll give you access to a ton of free resources. I have an online education course in there, and a lot of really great things that take you into a deeper dive on what it is that my strategy really is about. And also for you guys who are here today, I have a half a dozen or so books that really explain it well as well. So if you want to just contact me after we end here, I'll be happy to give you one.
Easiest thing to do would be to go to realestatecpa.guru. If you put your information in there, we'll set something up, then we can discuss your situation. Pretty much the most stress-free person. I want to guide you in the right direction if we're a good fit for you. I know. No, if you give me, happy to give you an initial complimentary consultation. If we can help you out, that's great. If we're a good fit, that's great. If we answer some tax questions and you go about your business, that's great too.
Well, it's at .guru, so must be good.
Correct.
If you want to see Chris in a turban, go there.
I'm going there. Jody?
For those of you that are sitting here, I did place on each table is a great flyer that gives you kind of just the absolute general basics of 1031 exchange. It tells you what like-kind property is, goes over the identification rules, and goes over different kind of information on the 1031 exchange. On the back, it does have some phone numbers as well as some websites. For those of you that are online, on live, we have an excellent website at apiexchange.com. What I will tell you, when you go to that site, we have over 180 different templates, is what we call them. They're one-page templates that go into, what if I have a partnership? What are the rules if my partner doesn't want to exchange? There's things of ground-up development as an exchange, a template. What if you own a vacation home? What are the rules of a vacation home to do an exchange? So if you go to our website at API Exchange, you can find those templates. And of course, if you want to reach me directly with questions, I don't know if I can be stress-free, but I can certainly calm your stress, hopefully. You can always reach me at 866, reach my Eastern Regional Office at 866-394-1031. Or you can reach me directly at 615-804, no, I can't even remember my own number, 406-2384, 406-2384. Thank you.
Roger?
When I first formed our company, I was writing a couple books, and I wanted a website, and my website developer came to me one day and said, if you could buy retirementcashflow.com, how much would you be willing to pay for it? And I said, quite a bit. Well, it turned out it only cost me a little over $700 to buy from the owner. So my website's real easy. It's just retirementcashflow.com. All one word, retirementcashflow. Or you can always catch me through my friend Jody here. We work together a lot. And finally, our office telephone number. You will seldom find me there, but they will find me. Unfortunately, I'm on airplanes consulting all over the country these days. Right now, between now and year end, I have New York, I have Sarasota, Florida, I have Pittsburgh, Pennsylvania, and I have Virginia. right now scheduled. And I know there'll be double that in 2 weeks probably. So I travel a lot. But my office number is 470-321-3946.
Awesome. Well, let's give a huge round of applause for our panelists today. Absolutely incredible. Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.